It's 23:17 a.m., January 21st, 2026. The overnight repo market closed 3 hours ago. Most people don't even know the overnight repo market exists, let alone understand why what happened there tonight matters more than every headline you'll read tomorrow morning. But if you knew what I just saw in the Federal Reserve's H41 statistical release, if you understood the quiet policy shift that went into effect at midnight, you'd realize we just crossed a line that can't be uncrossed. I'm a private commodities analyst who's been tracking institutional money flows for 14 years. I built this channel because I got tired of waiting for financial media to explain what's actually moving markets versus what they want you to think is moving markets. And tonight, something fundamental changed in the plumbing of the banking system, something that makes silver price manipulation impossible to maintain. Here's what I'm claiming, and I need you to understand this clearly because it's about to reshape everything. The Federal Reserve quietly removed silver from its approved collateral list for overnight repo operations. Not gold, not treasury bonds, not mortgage-backed securities, just silver. And this isn't some technical housekeeping adjustment. This is the financial equivalent of removing a load-bearing wall while the building is still occupied. The mainstream narrative tomorrow will ignore this completely. They'll talk about inflation data, jobless claims, whatever political theater is trending on social media. But what happened at 23:17 a.m. is the moment the largest banks in America lost their primary tool for suppressing silver prices. And they have exactly 24 days to unwind positions that have been building for over a decade. Let me explain the mechanism, because if you don't understand how the overnight repo system works, you won't grasp why this policy change is about to trigger the mother of all short squeezes. The repo market is where banks go every single night to borrow cash against collateral. It's a $4.5 trillion daily market that keeps the financial system liquid. Banks post assets like treasury bonds, corporate debt, or precious metals as collateral, and they receive overnight cash loans to meet their regulatory requirements. Here's the critical part. Major banks have been using their silver holdings as collateral to borrow cash, which they then use to short more silver futures. It's a circular mechanism. They post silver as collateral, get cash, use that cash to sell silver short, suppress the price, buy more physical silver at the suppressed price, post that as collateral, and repeat the cycle. This is how a relatively small physical position can control a much larger paper market. But at midnight tonight, the Fed said no more. Silver is no longer accepted as repo collateral, which means banks can't borrow against their silver holdings, which means they can't generate the cash flow needed to maintain their short positions, which means they have to close those positions or find alternative funding sources at much higher interest rates. Think of it like this. Imagine you're running a casino, but you've been using your own chips as collateral to borrow money from the house next door. Every night you take your chips, borrow cash against them, and use that cash to buy more chips to lend to gamblers who bet against the house. It's a beautiful system as long as the bank next door accepts your chips as collateral. But the moment they say your chips aren't good anymore, you have to find real money to fund your operations. And if you can't find real money, you have to shut down the casino. That's what just happened to the silver manipulation machine. The Fed removed the financial infrastructure that made price suppression economically sustainable. And the banks have until February 14th to comply with the new collateral requirements. Now, let me show you why February 14th matters specifically. That's not a random compliance date. It's exactly one day before the March silver futures contract reaches first notice day. First notice day is when futures contract holders can demand physical delivery instead of cash settlement. It's the moment when paper silver has to become real silver. The timing isn't coincidental. The Fed is forcing banks to close their short positions before delivery obligations kick in. Because if banks can't fund their shorts and delivery demands spike simultaneously, the entire fractional reserve system in precious metals collapses overnight. This isn't about orderly market correction. This is about preventing systemic breakdown. But here's where it gets dangerous. The banks don't just have small speculative positions they can unwind quietly. According to the most recent commitment of traders data, commercial banks are short approximately 87,000 contracts in silver futures. Each contract represents 5,000 ounces. That's 435 million ounces of paper silver that needs to be covered or delivered. To put that in perspective, total global silver mining production is roughly 800 million ounces per year. The banks are short more than half of annual global production, and they have 24 days to source physical metal or close paper positions before their funding mechanism disappears. The math is brutal. If they try to cover by buying futures contracts, the price explodes upward as massive buying pressure hits a relatively small market. If they try to source physical silver, there isn't enough available inventory in COMEX or LBMA vaults to satisfy demand. If they try to find alternative funding for their positions, the interest costs become prohibitive at current repo rates. Every option leads to the same outcome: a violent price reset that forces the paper price to converge with physical reality. Let me address the skeptics directly, because there are legitimate counter-arguments to the systemic squeeze thesis. The strongest objection is regulatory flexibility. The bears argue that the Fed will simply reverse this policy change if it creates market instability. They point to precedent from March 2020, when the Federal Reserve expanded collateral eligibility during the COVID crisis, and suggest the same flexibility exists in reverse. Here's why that argument fails. The March 2020 expansion was emergency crisis management to prevent deflationary collapse. Expanding collateral eligibility increases system liquidity during a liquidity crisis. But we're not in a liquidity crisis now. We're in an inflation management environment where the Fed is trying to reduce excess liquidity. Contracting collateral eligibility serves the Fed's current policy goals. It reduces the money supply by making it harder for banks to generate cash through repo operations. It forces deleveraging in speculative positions that contribute to asset bubble formation. From the Fed's perspective, this policy change kills two birds with one stone. It reduces systemic leverage and eliminates a manipulation mechanism that was distorting commodity price signals. The second skeptic argument is position rollover capability. The theory suggests that banks can simply roll their short positions into longer-dated contracts while they arrange alternative funding sources. This ignores the cost structure of maintaining unfunded positions. When banks lose repo financing, they have to fund short positions through traditional credit markets or internal capital allocation. The interest cost jumps from the federal funds rate, currently around 4.5%, to prime rate plus credit spreads, which runs closer to 7 to 8% for large positions. That's an immediate 300 basis point increase in carrying costs. On a 435 million ounce short position valued at current prices, that represents approximately $400 million in additional annual financing costs. That's not sustainable for speculative positions. That's balance sheet suicide for anything other than legitimate hedging operations. But this isn't the real problem yet. The real problem is what happens when other central banks follow the Fed's lead. The European Central Bank has been quietly reviewing its own collateral policies since October. The Bank of Japan announced a strategic materials framework assessment scheduled for completion in March. If even one major central bank removes silver from repo eligibility, the pressure on global banking system becomes exponentially worse. This creates what systems analysts call a cascading liquidation scenario. As funding costs rise and collateral options narrow, banks have to prioritize which positions to maintain and which positions to abandon. Speculative shorts in commodities are typically the first positions to be liquidated because they're non-core business activities with high opportunity costs. Here's my personal framework for tracking how this unfolds over the next 24 days. I'm monitoring 3 specific indicators that will tell us whether banks are capitulating or fighting the new funding constraints. First, futures open interest in March silver contracts. If open interest starts declining rapidly before first notice day, it means banks are closing positions rather than maintaining them at higher funding costs. That's bullish for prices because it removes selling pressure while confirming that the policy change is biting. Second, COMEX registered silver inventory movements. If registered inventory starts increasing significantly, it means banks are scrambling to source physical metal for potential delivery obligations. That would confirm they're taking the funding hit rather than closing positions, which suggests they believe this is a temporary policy that will be reversed. Third, overnight repo rates for alternative collateral. If repo rates for treasury bonds or corporate debt start declining relative to the federal funds rate, it means banks are shifting collateral preferences and creating excess demand for Fed-approved alternatives. That would indicate the silver exclusion is creating meaningful funding pressure. My trigger for escalation is simple. If futures open interest drops more than 15% while registered inventory remains stable, we're looking at mass position closure under funding stress. That scenario creates reflexive buying pressure as shorts cover simultaneously. Here's what I'm watching in my own positioning. I don't trade silver futures because I don't want counterparty risk with the same banks that are being forced to liquidate positions. But I am monitoring physical silver premiums over spot price as an indicator of stress in the physical market. When banks close short positions, they typically buy futures contracts to flatten their exposure. But if physical demand is strong simultaneously, the paper price rises faster than physical premiums compress. That creates an arbitrage opportunity where physical silver trades at a discount to futures prices, which almost never happens in normal markets. I'm also watching mining company financing costs. If banks are pulling back from commodity financing due to their own position management issues, mining companies will face higher borrowing costs for operations and expansion. That reduces future supply growth and supports higher long-term prices. This isn't about short-term trading profits. This is about understanding that a structural pillar of precious metals manipulation just got removed. The system that allowed unlimited paper silver creation backed by repo financing is gone. What remains is a market where physical supply constraints actually matter. The February 14th compliance deadline isn't negotiable. It's written into Federal Reserve regulatory guidance with no discretionary flexibility for individual institutions. Banks that don't comply face automatic restrictions on their primary dealer status, which affects their ability to participate in Treasury auctions and other Fed operations. That compliance deadline creates a hard floor under silver prices. Even if banks try to suppress prices through additional short selling in the final weeks, they know those positions have to be closed by Valentine's Day. Selling pressure with a known termination date creates buying opportunity for anyone with longer time horizons. But here's the elegant trap the Fed has constructed. By removing silver from repo collateral while maintaining gold eligibility, they've created a relative value play that favors gold over silver in the short term. Banks can still use gold for overnight funding, which reduces pressure to liquidate gold positions. This could explain why gold has been relatively stable while silver shows increasing volatility. The funding mechanism for gold manipulation remains intact, while the funding mechanism for silver manipulation has been eliminated. It's not that gold is fundamentally stronger, it's that gold price suppression remains economically viable, while silver price suppression has become prohibitively expensive. The policy asymmetry creates a window where silver could outperform gold dramatically, as silver shorts are forced to cover, while gold shorts maintain access to repo financing. This isn't permanent. Eventually, the Fed will likely remove gold from repo eligibility as well, but in the interim, silver faces unique upward pressure. We are looking at the controlled demolition of a manipulation mechanism that has kept silver prices artificially suppressed for over a decade. The Fed isn't doing this to help precious metals investors. They're doing this to reduce systemic leverage and eliminate distortions in commodity price signals that complicate monetary policy implementation. But the result is the same regardless of intent. The infrastructure that made massive naked short selling economically sustainable is being removed. What remains is a market where supply and demand fundamentals actually determine prices. The clock started ticking at 23:17 a.m. Banks have 24 days to adapt to a new funding reality where silver manipulation costs real money instead of leveraged money. The smart money isn't waiting to see how this plays out. They're positioning now for the reset that's coming. This isn't about predicting silver prices. This is about understanding that the game just changed. The rules that allowed unlimited paper creation backed by collateral that's no longer acceptable as collateral have been rewritten. And rewritten rules create opportunities for those who recognize the change before the market prices it in. The overnight repo market will open again tonight, but it won't work the same way it worked last night. And that difference changes everything.